For that, Lyn Alden is founder at Lyn Alden Investment Strategy. She's with us now with some perspective on markets. Lyn, good to have you with us here. Thanks very much. A lot of the stuff is kind of similar, not very much change in terms of news flow or markets really, but how do you view these protests in the US? And, it's another kind of battlefront opening up in California. What's your sense, Lyn? Will markets start to take note, and are they already taking note somewhere? What's your sense?
I think U.S. markets would take note if they became more severe. I don't really view this as much of an issue for markets outside of the U.S. Certainly, some U.S. problems obviously have very global reach in terms of their capital market impacts, whereas this one is primarily about U.S. political stability. If anything, if this deteriorates, it could give a bid to foreign assets. Here in the U.S., generally speaking, the markets tend to shrug things off unless they become very severe from a political standpoint. And so this is still a wait and see period. In general, this current period is kind of defined by headline driven markets. So the past couple of years, we're in very much liquidity driven markets, whereas here we're punctuated by headlines. Before it was tariffs. I think we're past the kind of peak tariff uncertainty, even though there are tariff issues going forward. Whereas now we're moving into more whether or not they're going to pass the bill and in what form, and also these protests and responses over in California.
Lyn, with regards to US, China, who do you think, how do you think markets will, what do markets want? I mean, the US wants these rare earth minerals, the supply to be opened up once again. China wants high-end chips. Although I think Kevin Hassett yesterday was on record to say that, well, we will provide some chips, but not the really high-end NVIDIA chips. So names like Qualcomm, etc., were up 4-5%. What's your sense, Lyn?
Yeah, so I think the markets want stability. They just generally want de-escalation, stability, clear sight. Obviously, the U.S. and Chinese governments want different things. Overall, I think China has the stronger hand here. And if this was happening back in President Trump's first term, it might be a different case. But they took a lot of preparation, China did, over the past several years. And so while they do have some weaknesses, like as you point, the very high-end semiconductors, generally speaking, the U.S. is more harmed by rare earth shortages, most likely, than China is harmed by shortages in the high-end semiconductors. And so the best case for both entities is de-escalation across the board. But I think the market's already kind of sussed out the fact that the U.S. has fairly low pain points when it comes to dealing with China. It had peak uncertainty back in April. And ever since then, it's kind of been understood that it's going to come and go. There's going to be ongoing frictions, especially for very import-driven businesses. But I do think we're past the peak level of uncertainty between these two, at least for now.
And maybe that's why the U.S. equity market, Lyn, it's been climbing every wall of worry, right? It's been such a great last 1 month. I mean, just the headline index, the S&P 500 is up 6%. Stocks have done even better. So where's all the chatter about rotating away from the U.S.? I remember when we spoke in March, you said that investors could be looking at more of those shifts, and some of that money moved to markets like, Europe. But what now? I mean, would you invest additional dollars back into the U.S.? Would you look at Asia, Europe? Where would you put the money?
I think the two most attractive markets are most likely China and Latin America broadly, Brazil and elsewhere. Those are probably the best long-term values that I think could benefit from ongoing capital rotation. Generally speaking, these capital rotation stories take a very long time to play out. They're not really done in a quarter or two, and they're usually not very sharp moves. And so I don't expect this one to be a sharp move either. And so going forward, I think basically the U.S. is not necessarily going to give up a ton of gains to the rest of the world, but I think it's going to be less of an outlier as it has been over the past 5, 10, even 15 years in many cases. There's very few markets that have been able to rival it. And I think when we look forward over the next 5, 7 years or so, the U.S. probably won't be one of the best performers. It could still very much be a top performer, and I don't expect major rotations out of it. But I do think that there are better values out there. And there has been still, even this year, even though there's been not any sort of sharp rotation, there's plenty of basing formations forming around the world, especially in some of those markets I mentioned, where I do think that we've seen the lows in those markets and that there's a lot of upside potential left.
All right. Hi, Lyn. Good morning. Always good to see you, Win. And I think your preference is for emerging markets over developed markets, if I remember correctly.
Yes, I think emerging markets have a better blend of valuation and growth. I'm still somewhat skeptical of European assets broadly. So I would pick my individual emerging markets and developed markets. But on average, I do think that China, Latin America, and a handful of other places have some of the more interesting prospects going forward.
Well, Lyn, you mentioned growth, and the Indian markets are the ones that are offering earnings growth. I think the problem you have had is with regard to valuations. While the Chinese market, you have inexpensive valuations out there, but growth is not really picking up. How would you weigh the two, and at what point of time would you say, all right, India is a market that's in a structural story. You'd rather, start focusing out here as well, because the toss-up between the two, you're leaning towards China.
Yeah, I think you summarized it well. I mean, with China and Brazil, you're looking at value markets. You're looking at very inexpensive markets. I think they have really good ratios of basically what their valuation is compared to their forward earnings potential. India overall has obviously much faster growth. The ratio is not quite attractive. India's rarely ever cheap. And so I think it's one of those things where India's continues to be one of those buy and hold stories. You just continue holding the equity market, especially if you're an investor outside of India and you want exposure to that market. So it's rarely near the top of my list, but it's also rarely near the bottom of my list. Another way of putting it is that if we do enter a more prolonged kind of stagnation in the dollar index, so we get a little bit of an easier dollar, some of the more dollar indebted markets have a lot more upside leverage from that. So that would primarily be Latin America and parts of more broadly Southeast Asia, whereas India is relatively protected from dollar indebtedness compared to many other markets that are classified as emerging. And so they generally have a lot of protections. And that also means that there's less kind of downside priced in right now. So India, I continue to be a buy and hold long-term investor of. And just in terms of maybe a 3+ year performance view, I generally view Latin America and China as perhaps the most interesting, kind of more contrarian type place.
All right, Lyn, we'll leave it there. Good conversation. Thank you very much for joining us. Appreciate it.